Hello everyone. Today on the final bar this Tuesday, November 26th, we're going to do a sector deep dive into consumer discretionary, a pretty diverse sector, so lots of really cool themes to pick out industry-wise. We'll recap today's movements, but also dig into the scooter rankings as part of our Level Up segment. My guest is Clint Cowles from TD Ameritrade, joining us from Minneapolis. Should be a really good show. Today, welcome to the final bar. Hello everyone, welcome to today's edition of The Final Bar. This is every weekday, 4 o'clock Eastern on StockCharts TV. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts in Redmond, Washington, a very chilly place today, but warm here at The Final Bar. Thanks so much for joining us, really appreciate it. You can get questions to us anytime. We're going to be doing a number of mailbag segments in the coming days and weeks, so shoot your questions to us via email, thefinalbar@stockcharts.com. We review everything you send in, and we'll address some of those great questions on the air here next week. Also, you can get to us on Twitter @FinalBarSCTV. Really interesting themes today, going into a holiday week here, heading into the Thanksgiving holiday in the US. So in general, volumes tend to be a little lighter. In general, the market tends to drift a little higher. So far, that's sort of what we're seeing this week. Doesn't tend to be huge market moving news, but all the rumors, all the comments, all the feeling we're getting externally all seems to be uplifting to the overall equity environment. So that's what we're going to dig into today. Really cool show though. My guest Clint Cowles, I met a couple months ago in Minneapolis, really sharp analyst. He shared a couple charts I'm really excited to share with you. We're also going to do a deep dive into the consumer discretionary sector. I think it's a really good time to do that going into the traditionally strongest time of the year for retail stocks. Let's get into today's trading with our market recap segment. This is what we do every day at the beginning of the show to just look at today's price action. Again, the goal is to connect what we're seeing today with the longer term trends. Make sure we have the proper perspective. So overall, this is where we ended up. Another up day. Yesterday was a nice breakthrough to new highs, new price highs, new closing highs. We had another follow through day to the upside. None of this is super surprising, to be honest with you. There's some earnings reports, but nothing huge this week, and plenty of news flow. But in the end, holiday weeks tend to be lighter volume, drifting a little bit higher, sort of like the base case for a holiday week. So we're sort of seeing that play out here. So interesting themes in the long term will continue to be to new highs. So as we talked about yesterday, in general, my opinion, you sort of turned into trend following mode. If you're not following the uptrend at this point, you better be. And again, the trend is formed of higher highs and higher lows. And as long as we keep establishing higher highs, which we've done again today, and as long as we keep establishing higher lows, which we did last week. So that 3090 level is the line in the sand. In this week going into next week, if we get any sort of pullback, as long as we remain above that 3090 level on the S&P 500, it's a real key one to watch. In terms of any potential red flags, I think you have to invest like a trend follower. You have to think like a contrarian, always looking for things that will invalidate your thesis or tell you to consider more risk than you might have in mind. So in terms of, in that light, things that might cause you concern or just should be on your list, a potential RSI bearish divergence that we're seeing here. So as the market's going to new highs, the RSI so far at a lower peak than it was about a week and a half ago. If that plays out and you see a little bit of a pullback and the RSI confirms a lower high, that would be a bearish divergence. Again, it's not the end of the world, but it's kind of what you saw here in July with a push to subsequent highs and a lower peaks in RSI. So that sort of bearish divergence could cause a little bit of negativity going forward, but that has not happened yet. We have to sort of see things. I want to look briefly at some global markets very quickly, just to hit on some of the themes that I think could be of interest. And again, I think one of the benefits of ETFs overall is that you have access to all these markets that years ago you probably would not have had or not have had been as readily available. This is the Earth Index. It's the MSCI World Index. The ticker is URTH for Earth. And this is a great way of just measuring overall equity health across the world. So about 50% US, 50% non-US. So it includes all global equity markets. Again, we see that potential divergence here with higher highs in price with lower highs in RSI. It's a little early on to be saying that that is a definite divergence because we haven't sort of finished this uptrend yet, potentially, right? If we continue to drift higher, the momentum could increase and we would see that sort of continue higher. But overall, this market, the global equity market, is undeniably in a bullish trend, higher highs, higher lows. And as long as that continues, in general, you want to be leaning on more of the risk-on side of investments. Let's look at a couple of key, I think, story ETFs so far. This is the Brazil ETF, ticker is EWZ. So this in general tends to be pretty commodity oriented play. So you'll find that the Brazil ETF tends to line up with what we're seeing in energy and in commodities. But overall, I thought it was worthwhile that, a gap down today on the EWZ, lower low, which is noteworthy, going right down to 41.50, which is below last week's low as well as the low from the week before. But notice what we saw today. Again, if you're a candlestick aficionado, it might be a little hard to see, but essentially, if you're a candlestick aficionado, that's called a dragonfly doji candle. And do not spend another moment worrying about why that is called that. Just think of it this way. You have an open and close right around the same level. You have a long lower shadow, meaning a low range that went well below those levels, and a small to no upper shadow, meaning we didn't get much above the open. So you think about today, we opened, we traded down, we bounced back and closed more at the highs, sort of like a hammer candle that we've talked about before on the show. So in general, more often than not, in a vacuum, that would suggest the next leg would probably be higher for the next couple bars. But again, you always want to wait and see what sort of follow through we have in the subsequent days. So interesting gap down, but short-term bullish read from EWZ. China is obviously another market that so many are talking about, thinking about the rumors that we see in China really impact overall markets. One thing I would remind you of is don't get too caught up into news flow specific to rumors, headline risk, short-term fluctuations, expectations for China-US trade agreements, because those tend to be very short-term oriented. A long-term investor, you're thinking more about the implications of a trade arrangement overall. And all that's happening is we're changing our expectations based on a short-term news item on what we might see going forward. So I would be concerned much more with the trend. Look at the price itself. That tells you what's happening. What we've seen now with the FXI in the last couple days, here's the gap up yesterday, the follow-through day today. So we've now rotated back higher. We've successfully bounced off the 50-day, now back above the 200-day, back above the most recent swing high from last week. Overall, now rotating short-term bullish on the FXI on China. Again, the relative strength pretty muted still, but overall starting to rotate a little bit higher. So within global ETFs, with the Earth Index and then a couple of those ETFs, Brazil and China, I think some interesting themes to pick out if you're not familiar with them. Again, I have a chart list with all of these ETFs. I'd encourage you to build something like this just to keep track of some of these global themes. Our next segment is a sector deep dive, and again, it's so easy to get caught up in some of the short-term movements. Occasionally, I like to really deep dive, go deep into a specific theme, and with sectors, it's really, really helpful. What I wanted to do was start with the consumer discretionary sector, start out with it at a high level, sort of talk about the sector performance overall, then dig into some of the themes that are driving the movements in the consumer discretionary sector, and hit on a couple individual stocks if we have time for it. So the main ETF tracking consumer discretionary is the XLY. I'm sure you're familiar with that. Overall, you can see how, again, not knowing what else is going on in the world, just looking at this ETF overall, feels sort of sideways consolidation-ish, right? That's not a word, but I just made it up. A consolidation phase of lower highs, of higher lows. You can see we're sort of in the middle of that range, just breaking up to a new swing high today with a close above the high from the last couple weeks, but overall still in really a sideways range-bound type of market. So you're waiting to see if we resolve this to the upside or the downside. What's hurting consumer discretionary is the relative performance. This is the performance of the XLY versus the S&P 500. You can see the relative performance sideways as it sort of mirror the overall market action, but then you can see the breakdown in relative strength. So this is one of those times when just looking at the price doesn't give you the whole story, because if you buy this and you're feeling good that it's holding up and it's not going down, the problem that the relative line tells you is that you're not in the right place at all. There are so many other parts of the US equity market that are going up. up, that are outperforming, that's more where you want to be, right? You want to be where you're adding more than the market averages, not underperforming them. So overall price is holding up okay, sort of sideways, but on a relative basis, it's going down. Now, one of the reasons, maybe the big reason, is because of the weightings in the XLY. So I'll ask you, what is the biggest weight in the XLY, in the consumer discretionary sector ETF? Do you know? It is Amazon, Amazon.com, by far the biggest weighting. Any guess of how big of a weight it is? This might surprise you. It's actually over 20%. It's 22% of the XLY is just Amazon. The second one is Home Depot, which is about 10%. Then you get into some other names, McDonald's about 6%, Nike 5%, Starbucks 4%. Then you get into Lowe's and a bunch of other stocks that are sort of in 4% or less. But there's probably 70, 80, 90 stocks in that ETF, and Amazon on its own is over a fifth of the weight, which means if Amazon is having trouble, which it certainly has been recently, that's going to put a weight on the entire XLY. So there are a couple things you can do about that. Number one, it's still this sector. That's still the exposure you want to pay attention to. But if you look at a ratio chart, so here, this is one of the charts we've looked at, looking at consumer discretionary versus consumer staples. So if this is going up, discretionary is outperforming. Going down, it's underperforming consumer staples. But at the bottom, it's that same ratio using equal weighted ETFs. So the equal weighted consumer discretionary. So instead of weighting it very heavily to Amazon, you're equal weighting. So Amazon has the same weighting as every other stock in that index. You can see overall much more constructive, right? So while the regular ratio using the regular cap weighted index definitely sideways over the last 3 months, you can see that over the last 3 months using the equal weighted ratios, it's clearly favoring consumer discretionary, breaking above that downtrend line using the peaks from April and again in July. We retested that in September, broke out, sort of came back, and now overall, I would argue in the last couple months, you can see a different divergence between those two. So that tells you that within consumer discretionary, there are plenty of names getting it done. There are plenty of stocks outperforming. It's just the biggest name, the biggest weight is having some trouble. And that's what's making it seem maybe less attractive than it might otherwise. So there are opportunities within the sector. Now, how do you break down consumer discretionary? It's one of my favorite sectors to look at in a deep level because some sectors are actually very homogenous, right? So energy, pretty homogeneous. I mean, there's the big integrateds, there's exploration production, there's refineries, but overall, they're really tied to the price of oil. So if you know what oil's doing, you have a pretty good read on what the energy sector is doing on average. Consumer discretionary has a ton of different types of businesses. So just looking at the industry summary page. So again, this is you go to charts and tools, go to industry summary. You can also get to it from your member dashboard page. This breaks down all the industry groups within consumer discretionary. Just sorting it alphabetically, you can read all the different types of stocks that are in here. These are very different stocks, obviously very tied to the consumer, but some of these are much more luxury oriented. Some of them are more home oriented. So a home improvements company, a home builder, very different than a gambling stock in terms of their business model, what's going to cause them to do well or do poorly overall, even in terms of the macro influences there. So it's a really interesting sector to look at because there's so many different things. So let's break down some of the themes within here. So if I sort them based on scooter rankings, which industries within consumer discretionary have been the strongest? Home construction, number one. If we look at the home construction index, this is something like just looking at the largest names, a lot of the home builders, Lennar, Pulte, D.R. Horton. We could bring up the chart of the overall index, or we could bring up some of these individual stocks. This is why the industry has done so well relative to all other industries, but especially within consumer discretionary, because you have stocks like Lennar that have been in nice uptrends, pulling back to the 50-day, recovering very, very nicely. Lennar is arguably at a pretty buyable point if you like the long-term story. It's sort of a weaker short-term move within a longer uptrend. That tends to be a pretty decent setup. Something like D.R. Horton a little further along, testing new highs, new closing highs again today. So home construction overall, pretty decent charts in there, right? Just looking at some of the individual ones. The second, we have furnishings, we have recreational products. Gambling, we actually talked about yesterday. It looks at things like Las Vegas Sands and others. So you can see how just at the little preview chart, the fact that this group had been sideways, now breaking to new highs. So these ones at the top of the scooter rankings are all groups that are breaking out at or near new highs and pretty constructive segments. Now, there are also things at the bottom of the list, so don't forget to look at the bottom. Things like restaurants come to mind. This includes things like Starbucks and Yum Brands and others that have had a lot of trouble. Overall, the long-term trend may resolve positive, but look at how challenging some of the charts have been. And just looking very quickly at the chart of that one, restaurants and bars. Here we go. We can see how it's now broken down through the 50-day, broken down through the 200-day. So within consumer discretionary, there are a lot of different opportunities. I would tell you, when you're looking at the largest level, when you're looking at the whole sector, remember there's a huge influence of Amazon and a couple other names. So looking at it on an equal weighted basis or within the industries might help you uncover some opportunities you wouldn't have seen otherwise. We're going to take a quick commercial break. Thanks for joining me for the deep dive. And we're going to come back with my guest, Clint Cowles from TD Ameritrade. We'll see you in a minute.
The Chart Watchers newsletter features expert technical commentary about the current market from some of the industry's leading technical analysts. See what's really happening in the markets through their eyes and gain an edge in your own investing. The newsletter is packed full of insightful and educational articles intended to help you become a better investor. Whether you are brand new to charting or a seasoned technical analyst, each edition will provide a wealth of informative content. It's the best way to stay informed on all the latest news, events, updates, and additions here at StockCharts.com. Whether it's a new feature or blog, an upcoming conference, or a special sale, you'll hear it first in the Chart Watchers newsletter.
Hello, everyone. Welcome back to the Final Bar. Thanks again for joining us every weekday here for our Closing Bell show, breaking down the price action. Joining me today, a very knowledgeable analyst and a gentleman I met in Minneapolis just a couple months ago, Clint Cowles, joining us from TD Ameritrade. Clint, thanks for coming on the show so much.
Absolutely. Thanks for having me.
You took the time to send a couple charts ahead of time. We really appreciate it. Very interesting visualization, so I'm dying to know what this is saying. First, we're looking at utilities. What are you seeing here?
Yeah, so I wanted to pull this up just because so many of the sectors have just been kind of, as you were talking earlier, just stair-stepping higher and continuing on that bullish trend. But the utilities are telling us a little bit different right now. So I wanted to bring this up, and this is zoomed in, just over the last 9 months or so. But this is still taking into account the last full year's worth of data. One of the important parts that I wanted to highlight here is that study over on the right side, and that's called the volume profile, just telling you how many shares have been traded at each price over the last year. So that is going to show you some inflection points, which those often act as support and resistance levels. So we got a double top there. It's about a $2 wide double top in the actual price. And then when it broke down from that center point, it pretty much just shot right down that entire $2, which is going to be that target measurement from that double top from that support break. But that is going to be able to move through that area so much quicker, because if you look over on the volume profile, there have been much fewer shares traded during that section, that $2 section, right after that support was broken. So when you see areas like that, it's just so much easier for the price just to drop through there fairly quickly, because there hasn't been as many shares traded there in the past. So that's certainly one part. We did get a throwback right up to the previous support, which is now acting as resistance. But the other two studies below that I wanted to highlight, we certainly got a break below zero on the MACD. That's the top one in the lower subgraph. But then also on the RSI, I know you were using RSI earlier too, and I love that study. But I look at it a little bit differently too. So when you're in a bullish trend, you'll often see that 40 level in the RSI act as support. You can see throughout the entire year before here, every time it got down to that level, it bounced right off it and continued its bullish trend. But now, for the first time really over the last year, that has now broken down below that 40 level. So that's certainly something significant to look at too. And also kind of looking at why this might be coming in right now, I put the 10-year yield up there. So the utility sector does tend to be quite interest rate sensitive. So when we've had the lower interest rates for the last quite a while, that has been a tailwind to the utility sector. But you can see just over the last couple of months, that downtrend in rates has kind of stalled a bit and started to stair step a little bit higher here. And I think that certainly has had a bit of an effect there on the utility sector.
It's such an interesting chart, and I love that use of RSI. It's sort of that traditional Connie Brown sort of way, right? Of thinking of it in bullish and bearish ranges, and I think that's a fantastic point about how utilities break down, and then it violates that 40 level. It sort of illustrates a rotation away from a defensive part of the market. The second chart you said was on small cap. So how is this relating to what we saw with utilities?
Yeah, so I wanted to pull this one up. This is something that I've been tracking here for quite a while. I like looking at the relationship between the small caps and the large caps, and certainly looking at the S&P continuing to stair step higher and make new records. The small caps here really haven't been participating in that for a long time. We've had that $15 range in IWM that we've broken out of to the top side once and the bottom side once, but then we got right back into it again. So it does look like we're starting to break out of that now. Had a great day at that yesterday. It has pulled back a little bit here towards the end of today. So we'll want to see that weekly candle, because this is a weekly chart. We'll want to see that weekly candle actually close outside of that range. That would certainly be a pretty bullish look. But as of right now, it is still looking like that's going to happen. So in those lower studies, again, we can see the MACD is now positive, and it has also reached higher than its previous highs there. So, that is certainly confirming that. And the same look on the RSI, we will want to see that break above that 65 level in order to give us a little bit more confidence that this breakout to the top side is actually going to come through. So we haven't gotten that part yet. That would certainly give us a little bit more confidence. The moving averages that I have up there are a 10-week and a 40-week moving average. And I know you have mentioned you use a 40-week because it's very similar to the 200-day. So we do have the 10-week above the 40-week moving average there. So that's a good sign. And the last point here on this one is looking at that volume profile. So when we saw that gap on the utility sector chart coming in and having that price drop fairly quickly right through that area where there haven't been many shares traded, well, if we can sustain this breakout on the small caps, there's also not many shares traded right above this area here either. So a jump up to that next spike could be pretty easy to come by. And here on a holiday week, when there's usually kind of lighter volume anyways, and an upward bias, it wouldn't be too surprising to see that kind of drift right up to that next spike. Now, if we can actually keep that and get some volume coming back in and supporting that coming into next week, then that's even better.
It's two fantastic charts, Clint. We don't have much time left, but I just wanted to ask you very quickly on this last one with the small caps. So I totally see what you're saying, sort of range bound, but testing that upper end, potentially entering a vacuum of volume, which you see on the right side there. What would indicate that that's a wrong call? What would indicate that this is turning more negative? Would there be a specific line in the sand, price level wise? Would it be breaking below this sort of congestion area? Would it be a breakdown of the moving averages, something with RSI? What would be sort of your first tell that small caps are starting to not work as you might expect?
Yeah, so like I said, the RSI there still has not broken above that 65 area. So the same kind of thing where we look at the 40 area for support in a bullish trend. At 65, a lot of times will act as resistance in a bearish trend. And until we break above that, and I'm certainly not going to have nearly as much confidence there.
Right.
Also, this is a weekly candle, and the week is not over yet. So although it's looking like it's breaking out right now, if we sell back off and get below that resistance point by the end of the week, that would be not as nearly as good of a signal, because instead of looking like a breakout, then we'd have either a shooting star or a tombstone doji kind of a candle pattern there, which would suggest that we would probably come back and test the mid-range there of support near the moving averages, and what's the point of control on that volume profile where more shares are traded than anything else over the last year. So finishing out this week, if we kind of sell back off and get below that resistance line, that would certainly not have that bullish breakout confidence like it's looking like right now.
Clint, fantastic to have you on the show. Thanks so much for joining us. Have a really good holiday. And I've always thought we are underweight Midwesterners on this show. So thanks for joining me, my friend. Love to have you again on later. All right?
All right. Thanks for having me.
All right. Thanks again, Clint. So that was Clint Cowles from TD Ameritrade joining us from Minneapolis. Some really cool charts thinking about congestion. I love the long-term perspective and thinking about RSI, touching on some of the things that we've looked at together, but nothing like seeing someone like Clint and how he approaches things. So that was fantastic. We are going to move very quickly to our next segment, which is a level up segment. So one of the things we've talked about is helping you learn to use StockCharts better. And a lot of this comes from questions that you send in. So please keep your questions coming. The final bar at StockCharts.com is the best way to send us things that we can address on the air. I had a couple questions recently about the scooter rankings, and I wanted to just share with you very briefly what they are, how I use them, and how you can use them on StockCharts. So there is a Chart School article that if you're not familiar, and I refer to them very often, and so I had some questions about what I was talking about. If you're not familiar with the scooter rankings, the StockCharts technical rank, go to the Chart School article that I'm showing you here on the screen and just search for scooter in the search bar, and that's a way to get here. It explains all the details behind the methodology. We actually tell you exactly what the methodology is. It's a trend following technique trying to show you where stocks are in their normal trending patterns. It's weighted more to long-term, but also includes some medium-term and short-term weightings, but 60% of it is more on the long-term side, so it's trying to capture long-term strength as much as possible, but we show you exactly what it is, and then the key is it turns it into a percentile ranking. So it goes essentially from 0 to 100. The top-ranked stock is going to be 99.9, going all the way down to 0 would be the lowest ranking stock. What's key is it is by universe. So all large cap stocks are ranked relative to all the other large cap stocks out there. We also do a small cap and a mid cap range. We also do an ETF rating, also an industry rating using the Dow industry groups. So the way that you can do it, a couple things to think about, but number one is the scooter ranking. So I showed you the industry summary before. If you go to your member dashboard, on the left side in the upper left, you have member tools, and you can go down and find scooter rankings, scooter reports. That's a really good place to go. I would also remind you, if you look at a particular name, so I'm going to bring up Home Depot very quickly, there is a chart style down here below your charts. If you look to my friend Greg Schnell, the Canadian technician, look at his chart style. He includes at the top a scooter ranking over time. So you can see, in this case, how it relates to the relative strength. Really interesting comparison, because relative strength is just a simple ratio. The scooter ranking is based on a percentile ranking. So relative strength shows you visually how the stock is doing versus the benchmark. The scooter ranking shows you how that relates to all the other names out there. That was a very brief level up segment on scooter rankings. I would encourage you to look at the Chart School article. There's a lot to unpack there, but we need to move to the end of the show, which means the 3 in 3. 3 charts that you should know in 3 minutes. We'll be a little under 3 minutes here because we're going to motor right on to the end here. Chart number 1, the XLF, the financial sector. We talked about consumer discretionary a little bit earlier. Clint Cowles talked about utilities. Here we're actually talking about financials. I love to ask people what their one chart is. What is the one chart that would give you a read on the overall market besides just the S&P 500? For me, my one chart today might be the XLF, because this is a broad 2-year base, sort of a complex head and shoulders pattern, but a break above that neckline I think was significant. The successful retest and the break to new closing highs last week into this week I think is key. We're now at above 30. If the XLF remains above 30 for an extended period of time, that tells you the market is in pretty good shape. It would be hard for the market to meaningfully correct with the XLF in such a good place. So that's chart number 1. Chart number 2, the ratio of consumer discretionary to consumer staples, in particular, the equal weighted version of that. We talked earlier in the consumer discretionary deep dive segment how important it is because of the weight of Amazon in the consumer discretionary ETF and in the sector index. If you look at the bottom, it's taking that impact away a little bit, and it's looking at the average consumer discretionary versus the average consumer staples, much more constructive, telling you there are opportunities within consumer discretionary if you have the right way to look for it. Home construction comes to mind immediately as a potential idea. The third chart for the 3 in 3 is the retail index. A lot of people have been talking about how retail's underperformed. You can see the relative performance going down, but it's just starting to turn higher, back above the 50-day, and if that can break to new swing highs, all of a sudden, if retail starts working, that is a theme that people, I would say, overall are not really feeling, and if it happens, I like looking for things that might catch people off guard, and if that's a theme to look for, this is the index that'll help you capture it. So that is a very quick rundown through the 3 in 3. I want to thank you so much for joining us here on the final bar. We are going to take the next couple days off for the Thanksgiving holiday, so we'll be back live on Monday, December 2nd. So please get all of your questions. If you're looking at charts over the holiday weekend, send your questions our way. The final bar at StockCharts.com. You can also look us up on YouTube as well as on Twitter at FinalBarSCTV. Also wanted to remind all of you, coming up, Cyber Monday is coming up this Monday after the Thanksgiving holiday. If you are waiting to renew your StockCharts membership, wait until Monday. Really good deal coming your way. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a good night.